Welcome to Industry Focus. I'm Nick Sciple. This week, I'm excited to welcome Will Thomson of Massif Capital back to the podcast. Last time, we took a look at the coming global energy transition and where potential may lie within that. This time around, we'll be discussing how ESG strategies may be starving capital from the industries that are most critical to leading that transition. Will, thanks again for joining me.
Thanks for having me, Nick.
Great to have you back on. As I said in the intro, we're going to be talking about ESG investing today. I pulled a couple of numbers just to frame the conversation off the bat. As of the end of second quarter 2020, according to Morningstar, 534 index funds are focused on sustainability, overseeing a combined $250 billion in the U.S. That's quadrupled in the past 3 years, the investment in these types of funds. Morgan Stanley said earlier this year that ESG will, quote, define the next decade of investing. Will, you just wrote a paper entitled Failure to Impact Are ESG Funds Delivering on Investors' Ambitions? Where do you think ESG funds are coming up short today?
Well, Nick, there are quite a few places, in our opinion, at least. So the paper, which we'll make available to your listeners, specifically focuses on sort of what ESG ETFs are doing in regards to accomplishing investors' goals as they relate to climate change and the environment. So one of the things our research has found, and sort of the research of some third parties like the Forum for Sustainable and Responsible Investors and Morgan Stanley, is that sort of climate change is one of the primary issues for investors that are focused on ESG, and that perhaps even more importantly, those investors, the vast majority of them, believe that their investments can influence climate change. We, as investors in sort of difficult to decarbonize industries that think they have a role in this transition, we're quite interested by that. And so when we dug into it, what we found is that if you buy an ESG ETF, you're really not making much of a difference, basically, is what it comes down to. The ETF and the way it is structured, the vast majority of the time, you're simply getting an index that is ranked and weighted according to these sort of very odd ESG ranking scores, and that really you end up being heavily allocated to companies that are certainly not, sort of negatively impacting the environment in a significant way, but also they aren't really making much of a difference. And so ESG ETFs and a lot of ESG mutual funds that take a similar approach to integrating ESG into their investment process, which is sort of this scoring that occurs after evaluation has taken place. They're mostly allocating to companies like Microsoft, Alphabet, Apple, Walt Disney. These are great businesses by, no question about it, but whether they're really promoting sort of change in regards to the climate and creating impact is, another story altogether.
Right. So it's this idea of avoiding maybe companies that emit into the world, but those dollars aren't necessarily directly reducing the amount of emissions being produced.
Absolutely. Absolutely. So, I think as we sort of look out at all the businesses that one can invest in, what one finds is that a lot of emissions come from sort of these economically critical industries that need to continue to exist in a decarbonized world, whether that be cement or steel manufacturers, whether that is mining companies, and those companies attract no capital in an ESG investment product, and in fact are sort of increasingly potentially becoming starved for capital. And those are the businesses, though, that require investment in order to enable a transition to a low carbon economy.
Right. So you talk about in the paper this idea of two types of firms that fit into that category of companies that aren't getting the capital they need, but if they're able to play they're going to play a role in this transition of the economy, assuming that they're able to get the investment necessary. You break those up into transitioners and enablers. What do you mean by those two terms?
Right. So you look at something like a steel company, right? And whether we are a low carbon economy or not, we need infrastructure, we need buildings, all of these, both of those things require steel inputs. manufacturing of all kinds requires steel inputs. So steel companies need to continue to exist, right? And they need to transition from their current processes, which are often very carbon intensive, to a low carbon footprint. And that low carbon footprint may mean that they are powering blast furnaces with hydrogen. There are also other methodologies that people are coming up with. Maybe it means more investment in electric arc furnaces powered by hydrogen, hydropower electricity. Either way, we need steel, but the business needs to transition to a low carbon footprint. It's not that we can just avoid decarbonizing steel, it's that we need to invest in steel in order to decarbonize it. And investing more in Microsoft or Apple simply isn't going to accomplish that goal.
Right. And so you look at the example maybe of electric vehicles, right? Massive amounts of capital has flown to that industry, to Tesla and other companies. And you've seen this industry develop in a way that it can really make an impact over this next decade, whereas you don't see that in some of these other industries.
Absolutely. So, I mean, as you said, Tesla is sort of one of the great examples. All that capital flowing into Tesla and Tesla only, basically, has changed the direction of the entire industry. You now see every car company, and just last week, GM came out with their electric Hummer. I mean, everyone is turning to electric, and a lot of it was driven by the capital flows that went into Tesla and the fear from everyone else that Tesla was going to eat their lunch. So a lot of people want, divestment strategies. They want to not be invested in oil and natural gas, not be invested in steel, not be invested in polluting companies. But the fact of the matter is that smart capital allocation to managers who are thinking about these problems in the long term is going to make a much greater sort of impact on solving the problem than just pulling capital from these businesses and allocating it to, again, businesses that sort of neither do harm nor good. And Tesla is a prime example of that.
Yeah. So you talk about, the auto industry. Elon Musk comes in and has turned this into something that people get very excited about. Do we need someone like that in the steel industry and the cement industry that makes this a sexy industry to invest in? How much of that is the marketing of some of these industries?
Yeah. I mean, I'm not sure how sexy cement can get, but it certainly wouldn't hurt. A little marketing acumen on the part of the steel producers, the glass manufacturers would certainly be helpful. Chemical industries, the list of industries that are significant emitters just goes on and on. Electricity and the transportation industry, the vast majority of the carbon emissions coming from autos, they make up a lot of the emissions, but only about 40% of global greenhouse gas emissions. And the rest of it comes from other industries. All those other industries have a Tesla in them somewhere. They have an Elon Musk in them somewhere. Is that person going to be quite as bombastic as Elon Musk? Probably not. But will there be significant returns? Absolutely.
Yeah, so where do you go about identifying these opportunities, these companies that are on the cutting edge of developing these new processes to make whether cement production or steel production cleaner? How do you go find these businesses that are doing that?
Yeah, so we tend to take a bit of sort of what we think of as a constraints-based approach. So we've looked at the IPCC and various different transition pathways. So the paths that think tanks and whatnot believe we need to go on to transition to a low carbon economy. And in those pathways, they often basically identify sort of like a carbon budget, right? So we can emit X amount of carbon between now and 2050 to achieve the goal of no more than 1.5 degrees or no more than 2 degrees. And you look at that carbon budget and you can say, okay, X amount can come from this industry, Y amount can come from this industry. You can sort of divvy it up and say within this budget, these are the constrained sort of points. There's no capital flowing to steel. There's no capital flowing to glass. There's no capital flowing to ammonia production methodologies that are low carbon. So within that carbon budget, we can then identify places where there is an opportunity for someone to either develop a new technology or an opportunity for instituting a new process or an opportunity for something sort of out of right field like carbon capture to make a significant impact. And within that, then you look for businesses and you look for management teams that are cognizant of those constraints and are looking for ways to make money by sort of breaking through. And in regards to the transitioners, sort of that is, at least in our mind, one of the better approaches.
Oh, yeah. So when it comes to these transitioners, tell me about a company that's in that subsector that you think is interesting right now and why.
Yeah, so I think transitioners are it's interesting when we look at the landscape, and we'll talk about the enablers in a moment, but the transitioners and enablers, there's going to be over the next 30 years this sort of give and take between the two. And at any given time, the path forward, if you will, the path of least resistance for transitioning firms of one kind or another is going to be easier or harder. Right now, transitioning firms is a difficult place to look. And the reason for that is because a lot of the technologies, a lot of the business strategies, a lot of the capital allocation that needs to occur is in very early stages. Okay, but one of the places where we think it's particularly interesting right now is a lot of sort of old school classic utilities. And specifically at the moment, at least, the European utilities are ahead of the US utilities. And so I think for your listeners who are mostly in the United States, one company that would be interesting to look at, which trades on an ADR with sufficient volume for sort of individual investors, would be something like RWE, which is a European utility. The ticker symbol in the US would be RWEOY. Okay, now what's interesting about RWE? So RWE is pivoting from being one of Europe's most polluting coal-based electric utilities into the third largest renewable energy producer in Europe, and thus one of the largest in the world, all as a result of this interesting asset swap that they did with E.ON, where they traded assets. Okay, and so what's happening is RWE has this huge pipeline now. They took all of E.ON's renewable assets and gave them a bunch of their transmission assets and a couple of other sort of bits and pieces here and there. And so now RWE has a giant pipeline of wind and solar, and that is going to result in sort of significant project pipeline growth going forward. There's going to be a premium in the market on what it is they're doing. There's going to be multiples expansion because the earnings quality versus, say, running a coal utility is going to increase. So there's going to be fundamental based catalysts that drive EPS growth and drive free cash flow growth. And then there's going to be a resulting sort of market premium based on multiple expansion. So you look at who their competitors are going to be once they finish this transition, which is going to take a couple of years. And it's going to be companies like Ørsted or EPD, both of whom trade at significantly higher multiples than RWE. So I think RWE and other European utilities that are clear on the fact that they are transitioning to renewable power producers as opposed to more traditional utilities that trade as an ADR in the United States are a great opportunity.
So why is the European opportunity, why is that a more attractive market relative to the US right now?
Right. So, and we kind of see this these days all over the place, but politics is playing an increasingly sort of important role in everybody's life, sort of in everything. And tackling climate change is one of these issues that every time we address a problem, it touches people, it touches businesses, it touches policy and politics. And so the regulatory role that governments play in the transition and in the industries that are sort of the highest polluters is quite high. And government plays an important role in those industries because they have historically been polluters. And from a regulatory perspective, the path forward for capital allocation for management teams is much clearer in Europe. When you go to invest a couple $100 million to $1 billion in various different projects, you sort of want clarity about what the regulatory regime going forward is going to be. And because there is sort of a consistent thought process, or at least a relatively consistent thought process in regards to climate change in Europe, the regulatory environment is just much more settled over there for the utilities. And it is becoming more settled for some of these other industries, and the path forward for some of them is becoming a little clearer also, especially with some of the new regulations and new programs arising out of COVID-related stimulus earlier this year.
So it's much easier to forecast the pathway because that regulatory environment's much clearer.
Whether it's easier to forecast or whether it's easier to see sort of multiple possible scenarios, I'll leave that up to individuals. We believe it's easier to see some multiple possible positive scenarios in Europe than it is in the United States.
While we're talking about utilities, you wrote recently in your most recent investor letter about this conundrum that utilities in the US and other places are facing. Utilities are regulated businesses and often are on a cost plus model. What challenges does that present for a company as it transitions more towards renewables?
Well, so it's kind of interesting, when you run one of these cost plus models, or you're in the sort of very contentious deregulated utility markets in the United States where margins are razor thin. The marginal cost of production plays an important role in setting, the electricity rates. Now that's the case in any market, of course, but it's particularly vicious in the utility market, if you will. And because renewable power has almost a zero marginal cost, right? You set up a solar panel, and once the solar panel is set up and everything's installed, all you need to do really is sort of keep it clean. There's no additional, you don't need to buy coal, you don't need to buy natural gas. So what ends up happening is the margins just sort of dive. There ends up being significant significant decline, if you will, in the earnings power of the assets, unless you continue to grow your base. And so one of the challenges that utilities in the United States are confronted with is investing in these assets with zero marginal cost and having this cost plus model while having a fixed sort of customer base. And so one thing we expect is going to happen in the United States is continued consolidation of the utility industry as they try to properly sequence the build out of new assets with growth of their sort of customer base, so that they can build out more assets and sort of continue to transition to renewable power.
Yes. So are these businesses going to have to look for new revenue streams, change the nature of the way they earn their dollars? How should we expect these businesses to change?
Yeah, no, I absolutely expect that they're going to need to change some of their business models for sure. And we're starting to see some of that in different places already in Europe, less so in the United States, but some of what might be coming is being seen in Europe already, which is more of a back and forth flow of payments between companies and the utilities, whether the companies are producing electricity or whether they are acting as companies can turn off or run at certain different times a day and be paid for that. And that has value to the utility, and there's sort of more of a back and forth flow. They're also monetizing, various different real estate that they have, advertising, things of that nature. So they're coming up with new ways of making money, electric vehicle chargers. There's all sorts of new things. No one's quite figured it out yet. But there are a lot of companies trying lots of little sort of pilot projects all over the place. And so that's still quite unsettled, but that they will need to do something else and do something different is almost certain.
Yeah, if you had to, as you look across the U.S., utility landscape, is there anybody who pops out to you as this is a company who seems to be on the right track or making the right moves?
I think AES is particularly interesting. AES is not solely based in the United States, but they are sort of a particularly interesting utility. I think they would be one of the opportunities I think that still exist. A couple of the guys like NextEra, they've already run quite a bit, and AES itself has doubled over the last couple of years. So there are a couple that have gotten a bit expensive, in our opinion. But AES would be one, NextEra would be another. So,
Right. And certainly those, if we're looking at consolidation, they can maybe use that stock price to help carry out some of that.
Well, it's certainly a possibility. Yeah.
Yeah. So that's those transitioners, these businesses like utilities, steel, cement, businesses that are already in existence that need to make some change to their process or to their business model in order to grow and participate in this energy transition that really needs to happen over these coming decades. When we look at enabler companies, how are those distinguishable from the transitioners?
Right. So, I mean, obviously, this is a framework we use to think, and so there's a little give and take here and there.
Sure.
Some of the enablers are transitioners themselves, and vice versa. But we look at enablers as sort of the businesses that produce some product that quite literally enables all these other guys to transition. Right. So, Vestas wind power, they build wind turbines. A lot of enablers in our mind are metals. Okay, the transition to a low carbon economy is incredibly metals intensive, just in every way, shape, and form. So there are a lot of businesses that produce goods that enable others to decarbonize. At the moment, we actually see enablers as one of the sort of largest opportunities in the market. For whatever reason, they're just sort of running ahead of the transitioning firms and the constraints in the system that might result in significant moves upwards in those companies are often based on supply and demand dynamics that are a little easier to see at the moment than for the transitioning firms.
Right. You've got this massive amount of capital flowing into, for example, electric vehicle companies. That requires a significant increase in production of batteries, which requires things like nickel, lithium, et cetera.
Yeah, absolutely. So, I think the numbers for, say, Tesla car, 1,000-pound lithium ion battery, you're looking at, I think it's 25 pounds of lithium, 30 pounds of cobalt, 60 pounds of nickel, 90 pounds of copper, 400 pounds of steel and aluminum. It's a lot of metal that goes into these things. And the same can be said of wind turbines, and the same can be said of solar panels.
And what is the level of investment in these industries today relative to the needs in the market?
Well, it's not enough. So, you look at the mining industry, and I think our most recent statistics for where sort of exploration dollars go, I think comes from 2018, and it's something along the lines of 40% of exploration dollars still go to looking for gold mines. I've made plenty of money in gold mines. I like gold mines as much as the next guy. But the fact of the matter is that gold doesn't make doesn't make a difference one way or the other to the transition. Whereas finding the next great copper deposit, we've gotten lucky in the last couple of years, and companies like Ivanhoe and Turquoise Hill have found some big deposits in Mongolia and the Democratic Republic of Congo. But finding a copper deposit and bringing it to production is very difficult. Nickel, even harder. Lithium, we've got plenty of lithium. Lithium's less challenging. It's more about picking the right company. But graphite's a particularly difficult business also. So there's a lot of investment that's got to go into these things. Aluminum, we don't have a lot of shortages or problem finding the inputs into aluminum, but the process of making aluminum is perhaps the most carbon intensive industrial process that we have on Earth, if you will. And yet aluminum is the single metal that is most consistently in all renewable technologies. So solar panels, for example, the entire frame is made out of aluminum. Cars increasingly, to sort of lighten their weight, have aluminum in them. Wind turbines, they've got aluminum. It's sort of just everywhere.
Sure. So you talk about this need to increase production of some of these raw materials at a time where it's more and more difficult to find really highly productive mines. As an investor, how do you identify the companies that are going to find these things? Because where do you go to look to find these businesses to invest in this opportunity?
Well, I mean, the easiest thing to do is to sort of pick your commodity first, and then just start listing out the companies that exist on the market. And everyone, especially with mining firms, everyone's going to be comfortable playing in a sort of different point in the company's life cycle. So You've got junior miners up in Canada that, they're nothing but geology. If you can assess geology and geological risk, that is a great place in the development curve of the mine to play. I would argue that probably most people aren't capable of assessing geological risk. And we as, largely mining investors, we spend, as much as 40% of our portfolios in mining at any given time. We don't even invest in sort of geological plays very often. Only when there's a management team that we really know well and we really can trust do we do that. That's a very difficult place to play. And if you want to create a portfolio of those types of companies, the answer would be you need to spend a lot of time doing research and put together a portfolio of probably 20 or 25 of them. It's much more of a sort of venture cap game than it is a concentrated portfolio. So you're going to have to be satisfied with the fact that a bunch of them are never going to become anything, and you're going to have zeros on those investments. Some of them are going to break even. You're going to get your money back, and then a couple of them are going to make all your returns. So if you're not comfortable with that, then you can sort of move over. And these companies all have a bit of a life cycle in the market, and they sort of tend to pop once a geological discovery has been made, and then once everyone sort of settles into the fact that this is going to be a 3, 5, 10-year process to build a mine, they tend to sell off again. And down there in that trough, where there's been significant de-risking and maybe the company's achieved financing already, or they've already got a plan for the mine and construction is underway, significant de-risking has occurred. It becomes more of an engineering and an execution problem. And so if you've got the skill set to analyze that type of issue, that's a great place to be. And that tends to be where we play. And you can take a much more concentrated portfolio approach there. And then if you've got none of those skills, you're best off probably looking at, just focusing exclusively on sort of maybe a couple of management teams that you're comfortable with and do you think are trustworthy, or heading over to some of the bigger guys at a point in time when they sell off. The big guys like a BHP or a Rio Tinto, they cover all the metals. Glencore heavily invested in all kinds of different transition metals. If you can get them at the right price and you're comfortable just holding them for the long term, they might sort of work out well for you. So the mining investment space is difficult, but if you are cognizant of what your skill set is and you're willing to do the work, I don't think any industry more frequently throws up opportunities that could potentially make a lot of money than the mining industry. But the key is potentially make a lot of money. So.
Yeah, potentially is doing a lot of work there in that sentence there. So you talked about maybe you want to split it off into different commodities of interest. One that I know a lot of people are interested in right now, just because of the electric vehicle space, is lithium. You have some investments in that space. When you look at that area, are there any companies that fall into that second category you mentioned that you find of interest that folks should have on their radar?
I think our favorite, at least, is Lithium America, or LAC. It trades on the NYSE. So all your American listeners sort of can buy into it easily. They have a deposit in Argentina, a brine deposit that is going to come online shortly. It's a very large deposit. They've already pre-sold, or they have an agreement, if you will, an offtake agreement with Ganfeng, which is a Chinese lithium and battery producer. So they've pre-sold all of the mine's production. And then they have a developing deposit in the United States, actually right near sort of where Elon Musk has bought a bunch of property that he thinks he's going to build a lithium mine at, that they will develop over the next couple of years. And once both these deposits are up and running, they will be one of the largest producers of lithium in the world. And it's a very solid management team. One of the things that's tricky about lithium is I'm not the one who came up with this. Someone else did, so I'm just quoting him. Lithium is more of a chemical business with a mine attached than it is a mining business. So the actual processing of lithium is quite complex and quite important. And so you need a management team with significant experience. And the LAC management team all comes from Livent, FMC, and Albemarle, which are sort of the three big lithium producers who have been in the business of producing lithium for many years and sort of know how to take this rock and turn it into a useful chemical, basically.
Yeah, you mentioned earlier this idea that we actually have a decent amount of lithium. Is that processing and those grades of the metal, is that really the distinguishing factor here?
Yes, absolutely. So no shortage of lithium out there. The question is whether you can take it and turn it into the grade and type of lithium that a particular battery producer wants. And all the battery producers seem to have slightly different, the broad chemistries are roughly the same, but every producer requires a slightly different tweak, it seems like, to their lithium. And so being able to produce just what that battery producer is looking for is quite important.
So Lithium America LAC is one to keep your eye on. As you look at some of these other metals, nickel, copper, aluminum, what are some companies in those categories that maybe jump out to you?
Well, in the copper space, for the very intrepid, we still think Turquoise Hill is a fantastic opportunity. TRQ is the ticker symbol. Turquoise Hill has been a bit of a challenged asset, and they are not at production. Well, they've got an open pit mine in Mongolia. The open pit mine also has an underground mine that's being developed. The underground mine will come online in the next couple of years. It'll be quite an interesting and unique mine because of the scale at which they're operating what is called a block cave mine. It's going to be one of the largest block cave mines in the world. And block cave mining just happens to be a very challenging sort of approach to mining. But that it is one of the largest copper deposits with just great grades and great gold, sort of gold byproducts, is certainly true. It sits there on the Mongolia border with China, so their primary customer is right there. Buying it right now, I think you're getting it pretty cheap. There are absolutely risks involved, and there are some political risks involved with the Mongolian government. You are partnering very much so with Rio Tinto, who owns 51%, and sort of every 6 months is rumored to be coming up with some sort of scheme to take over the entire company at a discount to its current market cap. Might that come to pass? It theoretically could. Our bet is that if they do, you at least get paid a little bit of a premium from here. So we think Turquoise Hill is interesting. Another great one is Ivanhoe, which a guy by the name of Robert Friedland discovered the OT mine, which is owned by Rio Tinto. He's also the sort of discoverer of the Kamoa-Kakula mine in the Democratic Republic of Congo, which is owned by Ivanhoe. It is just this most spectacular copper deposit I've ever seen. The grades are many multiples the grades of basically all other copper deposits around the world. They will be the lowest cost producer on the cost curve, save for a couple of these copper mines that have just absurd gold byproducts, is absolutely true. That no one can produce the scale of copper that they're going to produce at the cost that they're going to produce it at is almost certain.
Yeah. So given these dynamics that we talked about earlier, of I think everybody believes, and you see governments taking steps that will require energy transition, move to renewables, move to electric vehicles, et cetera, and all these inputs are going to be necessary for that to take place. Why are these companies still a compelling valuation in your view? Like, why hasn't the market realized this? It seems obvious when you lay it out there.
No, I mean, look, you look at something again like Turquoise Hill. Turquoise Hill has had a challenge past, and I think that challenge past, which is still, it still weighs on the company. they still, the underground mine is still not up and running. That they need to go out and raise some additional capital and will dilute shareholders currently who own it is certain also. Okay, so there are absolute drawbacks. That everyone sort of in the mining space, or a lot of people in the mining space, got burned on copper miners and gold miners and iron ore companies, within the last 5 to 10 years is also certainly true. That in the United States in particular, ETFs and index investing is driving people towards, allocations towards the S&P 500, an index that has no mining companies in it, or is driving people to, the QQQs and NASDAQs. That's certainly got a role to play. The sort of love affair that we have, and appropriately so at one point, with asset light software companies, at one time that was a cheap and fantastic opportunity. Now at this point, whether those companies are still the fantastic growth opportunity that they once were, or are getting a little expensive, I think is an open question. But all of that, all those flows, if you will, into those businesses have taken flows away from and attention away from a lot of these real asset businesses. And so I think, just a couple of weeks ago, one of the sort of major investment banks in London, they just fired their entire mining team. They just let it go. Nobody was interested. Another one, and this is a little more understandable, perhaps, just let go their entire oil and natural gas team. That there is opportunity and value in some of these businesses due to distraction or lack of interest is certainly the case. That it may take some time for that to reverse itself is also the case. But because of real world constraints in both sort of science and physics, and the fact that, it's great to decarbonize, but software can't do it, it takes a little while for that to filter through and for people to recognize it and to change their sort of way of thinking.
Right, certainly. Until this these EV markets, et cetera, mature to where the demand catches up, it's not going to trickle down to these suppliers.
Yeah, no, absolutely. I mean, I think lithium and cobalt have both had sort of a rocky history as of late, with a bubble in both that definitely burst, and part of that was driven by sort of excitement about EVs and then them not sort of panning out the way people thought they would. Of course, that we're not replacing 18 million cars a year with EVs at this early stage isn't surprising. Transitions in the real world are much slower than transitions in the world of software. And so I actually think there's something interesting going on where we've become quite accustomed during the sort of information revolution, if you will, over the last 20 years, to things occurring at these really fast paces. Of course, when you have real science and engineering challenges, those things don't change quite as quickly. How many miles and how much time do you need to run a car before you're comfortable selling it to the public? Or how much time does a test plant for some new chemical process or energy production methodology need before you're comfortable spending $1 billion building a full scale? Building a mine, copper mine takes 10 or 15 years to build. So these transitions are occurring at a pace that is slower and will continue to be slower than people think, in part because we've gotten so accustomed to transitions occurring so quickly.
Right. I mean, it takes a long time to begin with. Plus, you need the capital to do so. Do you think that this shift of capital flows is pushing back the pace of transition further than it would have been otherwise?
To the degree that management teams are looking at, and we all know that they look quarter to quarter, and we'd like everyone to look sort of long term, but they don't always do that, and they're incentivized. Sometimes they're incentivized properly, sometimes they aren't. To the degree that management teams are just looking at their company stock quarter to quarter, they're just not going to go out and make big, bold strategic transition decisions or make big, bold capital allocation decisions. And so, to the degree that capital continues to flow away from them rather than into them, yes, it'll slow down the transition. That you can say mine copper or mine nickel or produce steel in a economically and environmentally sustainable way. And they both have to be sustainable. The economics and the environment both need to be sustainable. That you can do it is absolutely true. That these companies have the footprints already to do it is less true. So they need to make large capital allocation decisions. And with large capital allocation decisions, you need, a shareholder base who's willing to stick with you, who's willing to look long term and sort of empower management to make these bold decisions that in the end, some of them are not going to work, but some of them are going to be really value creative. Okay, it isn't just going to be buying back shares. You're going to create real value that grows the business.
Yeah, so we talked earlier about how access to capital is impacting some of these companies. This year, we've seen this huge rise in SPAC investing as a new way to get capital to companies. Particularly, it's been late stage software companies as well as some pre-revenue electric vehicle companies. Do you see that as being an avenue that could solve this funding problem for mining companies?
So there are a couple of rare earth metal SPACs, or at least one that I can think of, that in that particular case, it's an appropriate sort of medium to come to market. Seems a reason, I can't critique it, if you will, right? That SPACs represent a potentially interesting path forward for clean energy technologies more broadly, I think is the case. That SPACs have a few issues of their own that we're currently seeing some people resolve by sort of not allocating shares to owners as cheaply and or sponsors of the SPAC as cheaply as has historically happened is the case. I think is an important part of whether SPACs become a path forward for a lot of these clean energy technologies. But the historical way that new technologies have been financed, the VC route, is a bit of a difficult route for capital intensive projects. And a lot of these real asset industries have capital intensive projects, right? And so a VC, they want to be able to sort of see a path to ramping up, to scaling, and to getting out sort of within 10 years. And that timeline has obviously gotten extended with things like Uber and some of these larger companies that have stayed private for longer. But that they want to see a path to getting out and scaling is certainly true. And that's much harder with a real asset industry, that you can sort of have a technology and then come to market via a SPAC and have a real, significant source of capital, a couple $100 million right off the bat to build pilot projects that you can, show potential customers is potentially quite value added. And it's a potentially interesting path for a lot of clean energy technologies.
Certainly, I guess it escapes that VC problem of you need to be able to see incredible growth. And, this idea, Peter Thiel wants to own the entire market. I don't think you're ever going to own the entire market for a commodity. So a little bit different value proposition there.
Yeah, absolutely. Very much so.
You mentioned rare earths. We see this industry pop up here and there. I believe it was maybe a decade ago was the last time it had super high interest. Just this month, President Trump signed an executive order declaring a national emergency in the mining industry aimed at boosting domestic production of rare earth minerals, reducing dependence on China. What do you make of rare earths? Do you think that this is something that folks should be paying attention to, or do you think it's overhyped?
I think it's overhyped. One of the things that's quite tricky with commodity businesses and sort of understanding the supply and demand dynamics is that the size of the industry versus the scale of the producers and what they're capable of producing can create these weird dynamics. So the rare earth metal market is extremely small. Okay, so the SPAC that is coming online, MP Materials, owns Mountain Pass out in California, which produces neodymium and praseodymium, and hopefully I pronounced those correctly. The total market for those metals is 34,000 kilograms a year. Kilotons or kilograms a year. Must be kilotons. They're going to produce somewhere between the single mine, when it's fully up and running, they're going to produce something between 15 and 20% of the global market. So they're just going to drop basically 20% more supply, or 15%, somewhere between those two, into the market. And because it's so small, the ability to absorb that new supply as it comes online is quite constrained. Now, the hope with rare earths, of course, is that electric cars and various electrification technologies grow exponentially and absorb it. But as we've already seen, say with lithium and cobalt, getting that timing sort of just right is quite difficult. And frankly, it's not that you can get the timing right. A company might get lucky and happen to bring on its mine at just the right time, but that management can foresee with enough clarity that they can sequence bringing a mine online at just the right time. It's just nonsense. That there is a theoretical long-term opportunity in rare earths, I'm willing to absolutely entertain that proposition. That I have yet to see a rare earth mining company that was a continuously profitable and value creative business. I just haven't seen one. Now, admittedly, there aren't that many, but Lynas Corp, which is in Australia and is sort of like the largest publicly traded rare earth miner. If you get your timing just right on the equity side, you'll make some money, because from time to time they make money. But the point is that the market is so small, the supply and demand dynamics so tricky, that they only make money some of the time. It's just with highly niche metals that are sold, not on open markets, but on contract. It's just very tricky to sort of get it right at both the operator level and at the equity investor level. So MP Materials, the SPAC that's coming online, I think it's interesting. I've read the S4, the registration documents. It's certainly intriguing. I'm going to keep an eye on it, but I'm certainly not going to sort of buy it here in absence of a lot more information than we currently have coming to us. I'd also just sort of add that in regards to that particular SPAC, there's some sort of interesting dynamics going on. There is a Chinese owner, and part of the reason that Donald Trump declared an emergency, of course, in rare earths is because China owns so much of the rare earth metal market. So what role that Chinese owner plays in this company going forward, and I think when the company's public, it's going to own about 10%, is an open question, or 6 to 10%. So I think there's some interesting dynamics at play, and it's going to be an interesting process and story to watch. That it is investable now, though, I think is probably an open question.
Right. So it's a bigger deal for the markets that'll be supplying than it is for maybe the people who might potentially invest in the equity of the business.
I think so. Yes.
And is this one of those high prices solve high prices things, like maybe you see in oil where once that opportunity in rare earths presents itself, suddenly you have folks exploring for the metal, and then that floods supply and rinse repeat?
Yeah, I think so. I think that's a good way of putting it. I think that's a pretty common sort of path for a lot of markets. That's sort of capital cycle analysis, if you will, that people will flood markets where there's an opportunity to make money, and then because they flood the market, the money to be made will sort of decline. Margins will decline. You see that at play in almost all commodities, but it just goes into hyper overdrive, if you will, when the market is so very small.
So that raises a question for me now. We've talked about this point in time where there's clearly growth in the end markets for some of these commodities, but they're starved for capital. Do you see this as, we're at the beginning of what could be a new cycle? And if so, how long do these cycles typically run?
That we are at the early stage of a potentially positive cycle for a lot of these metals, I think is true. Is it, 10 years ago, you heard people talking about, say, commodity super cycle and things of that nature. This is a commodity super cycle. Yeah, I'm not going to make that claim. That we're entering a good environment, which is all you really need, for metals like copper, lithium, or nickel over the next 10 to 20 years, I think that's absolutely true. That they can last 10, 20, or 30 years, I think is absolutely true in this case also. If you just look at sort of how long it's going to take to replace a lot of existing assets, especially on the EV side, it's going to take a long time. It's not going to be, you're not going to get a pop, make a bunch of money by investing in Tesla right now, and then go away and never make money again. There are going to be opportunities that come up over and over and over again over the next 10 to 20 years in some of these sort of enablers of the transition.
We talked earlier about this idea that ESG funds are leading to capital being starved from these industries that are really going to be most important to reducing emissions going into the future and transitioning our economy to a cleaner energy infrastructure. What advice do you have for retail investors who want to make those types of impactful investments in the economy, given those limitations of ESG funds?
Yeah, so I would again, emphasize sort of looking at the world of carbon emissions in a bit of a constraint-based framework. Look for those those pinch points. Look for the places where there is a lot of carbon emissions, a lot of greenhouse gas emissions, and no one is trying to address the problem, or the solutions to the problem are not attracting any attention, right? So, everybody's looking at the auto industry right now. That there will be money made in it is absolutely certain, but that you, the individual sitting there doing research on your own, are going to find the next great opportunity is probably unlikely with all the eyes that are on it. So, look to some of those out of the way industries that feed into solving the problems in some of the industries that aren't attracting the attention. So the steel industry, the cement industry, the glass industry, the chemical industry is a huge carbon emitter, and we use chemicals everywhere. Chemicals aren't going anywhere, okay? Everyone needs paints and laminates and glues and sealants, okay? These things, I look at my desk and every product has some sort of chemical in it somewhere in some way. How are those industries going to decarbonize? Where are the opportunities in those industries? Where are the constraints that are preventing a transition? And who is looking at addressing those constraints? That would be my advice. It takes shoe leather, but good investing always does.
Absolutely. These are the folks who there's not a lot of people competing in those industries, so where there may be some opportunities. Will, thanks again for joining us on the podcast. As this continues to play out, we'd love to have you back on again to talk about some other opportunities to invest in.
Absolutely. I'd love to do so.
As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed. So don't buy or sell anything based solely on what you hear. Thanks to Steve Broido for mixing the show. For Will Thomson, I'm Nick Sciple. Thanks for listening, and Fool on.